Hi guys, I've been sent and I am on a property development syndicate that's looking to raise about $3 million from a range of wholesale investors in order to develop a property. It's 23 townhouses, and I thought to myself, well, this is a great segue into a video that I can do on the types of due diligence that I conduct when considering investing in a property development fund or property development syndicate. I didn't want it to be a generic, oh, these are the risks and these are the structures video. It's more about the opinion that I look at in terms of the fees, in terms of the structure, in terms of the actual project and the financial assumptions, so you can have an idea of the types of benchmarks I use when considering a property development fund. This way, hopefully, you can use those benchmarks and opinions in your own assessment of due diligence. And the whole idea of due diligence is helping you be able to assess deals to find the best returns and avoid the investments or the syndicates that could potentially lose you money. As always, the boring but important stuff. This is not any form of financial advice. You need to speak to your own advisor and do your own research. By going past this point in the video, you agree to be bound by the disclaimer, which is linked in the description section of this video below. So first things first is this document is marked confidential all over it, meaning that this video is only between you and me. Also, if you're the syndicator, please don't sue me. I never solicited for this document, I asked for it. It was actually sent to me from a couple of different stockbrokers raising money for your deal, and I never signed a CA. It was just sent through to me. So I hope it is not as confidential as all the documentation says. Where do I start my due diligence? Well, the first thing that I look at is fees. And you can see on this particular development that there are 5 different fees on the project, which they are disclosing. And let me get into each of these fees in a little bit more detail to give you an idea of what I see when looking at them. The first fee I'm going to get into is the development manager fee. And the way this is structured is it's 4% of the gross realized value. Now the gross realized value, the gross end value, is basically the total revenue of the project, inclusive GST, inclusive deductions such as sales commission, basically everything, the total package. And it's 4%, so on this project it works out to being about $655,000, which is confirmed in another part of the IM. I'd normally like to see this fee broken down a little bit further in terms of how it's paid. Firstly, is it paid up front? All day one, $655,000, or is it paid at key milestones in the project such as DA, construction and completion, or is it back-ended towards the end of the deal? Ultimately, as an investor, the best type of project management fee is as far down the track as possible because this incentivizes the syndicator in order to complete the project. Ultimately, I'm not comfortable if more than 50% of the fee is paid prior to construction commencing on the development because this is the hardest milestone to complete. The other thing I'd like to know is, are these fees written up and down, or are they only just written up? For example, if the GRV increases, does the fee increase with it? Or if the GRV of the project comes down, does the fee get reduced down with it? The other fee on top of the project manager's fee is also the acquisition fee, which works out to being about $110,000 on a $3.5 million purchase price. This fee for project management at about 4% and on acquisition at 2.65% is towards the top end. Normally, I'd see the project management fee commercially at around 3%, 2 to 3%, and the acquisition fee sub 2%. Adding on top of these two fees is also a capital raising fee, which is 4% of the capital. So on $3 million, that works out to about $120,000. The next fee on top of all of these is the 1% director's fee for personal guarantees on debt. This is a little bit more involved and harder to explain, but I'm going to go through it now. Firstly, they propose that there is 2 facilities which the development will be using. Firstly, there's a $1.5 million facility to purchase the land. Then they're going to roll this into a construction facility of about $8 million. So my question to them would be, is the 1% director's fee on the $9.4 million, the combined of the 2 facilities, or provided your exposure at any given time is only $8 million, is this a 1% fee on just the peak debt? The other devil in the detail is that the fund will be paying for directors and office holders insurance, which on a project of this size would be about $20,000 to $30,000. I don't entirely understand that line because directors and office holders insurance doesn't cover personal guarantees, it covers other litigation risk to the directors. So I'm unsure as to why it should cover D&O insurance if the fund takes on debt. The final thing worth mentioning is in other parts of this IM, they do state that they believe that they wouldn't need any form of recourse debt or personal guarantees. Now, in my experience, and this is only my experience, on projects of this scale, geared to this level, that need pre-sales through a primary lender, so your main banks, would more than likely need some form of personal or director's guarantee. Now, I take a view differently to what's documented in this IM. So what I would do is I would take into account this fee when I'm backward engineering my feasibility and returns, because I think that they probably would need it. When we add up all the fees, it works out to being about $980,000 going to the syndicator for raising $3 million of equity. This is about 33%, and this is pretty high. Normally, I'd like to see this around the 20% mark, but that would be in an ideal world. The next thing I want to talk about is the selling agent's fee, and I want to discuss other ways that syndicators make money from fees which are disclosed in the IM. Firstly, and the most simplest way, is that they own the selling agency, which is ultimately going to be selling these townhouses, and effectively they've disclosed this fee of 2%, which means that they can gain that full fee of 2%. The second way syndicators make money from disclosing fees like this and binding you into a percentage up front is they then tender out the selling agency work to somebody else at 1.5%, for example, and they make a clip of 0.5% on the sales because they've disclosed a higher fee up to you. This method of disclosing a fee to investor and then tendering out a cheaper rate is a pretty common method that syndicators use in the disclosure section of the IM. So any fees that they've put a fixed fee in here that they could potentially gain is potentially a fee that they're tendering out to somebody else at a lower rate. Onto the profit share, which is a little bit vague, and I would expect that the trust deed would go into an actual formal calculation around how this is worked out. But the way I read it is that the syndicator effectively gets 50% of the profit plus 5% of the GST when the syndicate's equity gets an internal rate of return in excess of 16% per annum. The reason why the syndicator uses internal rate of return on equity is because this is the most volatile number. I personally would prefer a performance benchmark attached to the total IRR on the project or the margin on development cost. So this brings me on to another question around the IM on the performance fee, and that is that the internal rate of return on equity in the IM is suggested to be about 22%. Is this number inclusive or exclusive of the performance fee? A lot of the due diligence around fees in this particular project has ultimately ended up in asking more questions to the syndicator. It's probably not because of the documentation in the IM, it can't cover everything, but it's the fact that they don't have a full feasibility in the IM where I can clearly see how they've accounted for all their fees in their financials. So this brings me on to my mini disclaimer, which is ultimately some of those questions could already be answered in the IM or the full feasibility, and I may have made some wrong assumptions because I don't have access to the full feasibility on this particular project. While on the topic of fees, the other thing worth mentioning is project expenses. Now, in this particular syndicate, most of the project's expenses look fairly straightforward and related to the project, but the thing worth mentioning is the last one, and that basically states if there is any cost as reasonably determined by the project manager to relate to the project, then this will be borne by the syndicate. This is a little bit vague, and I just wanted to talk about some examples, and I'm not suggesting that these guys are doing it. For example, if the syndicator has to lease some office space as a project manager, and the project makes up, say, 20 or 30% of their total projects, does that mean that they can charge 20 to 30% of their rent to the syndicate so that they can recover some of their operating expenses? Also, if they were to have lunch with the builder, and this is related to discussing the project, does that mean that that lunch is covered by the syndicate? Now, ultimately, I'm not suggesting that these guys are doing it, but it is something that you need to be mindful of. A good way to work out is the costs related believable, not believable, but fair, is I would ask examples of how they've dealt with costs in the past on previous syndicates, and this will give you an idea as to what things you'll see charged into your syndicate. In terms of things that I would conduct due diligence into the offer, I want to talk to you through some of my opinions. First things first is this is done in a company structure where they have a single company that issues shares, and you basically own a share within the company that owns the property. Now, personally, I would prefer to consider a unit trust, and the reason why I would consider a unit trust, and I'm not a tax lawyer or an accountant, is because the tax situation of a unit trust is a little bit better, being that the incomes distributes to the investors, and then effectively it's up to the investors to determine their tax situation, where with a company structure, you basically get dividends, and those dividends are already taxed when they're paid to you. Moving on to the company itself that you're buying shares in, or if it's a trust, the trustee company that you're buying shares in. Now, the first hint to me is Wandoo Projects is probably not related to this particular development site. And when I jump on ASIC and have a look at when the company was registered, it was registered on the 1st of July. So my question to the syndicators would be, has this been used for anything else? In the IM, it does state that the company was set up solely for this particular project, but ultimately, if it was set up almost 12 months before I saw the IM, then why is it been operating as a shell for so long? And again, I would just confirm this with the syndicator. While we're on the topic of the company and the formation, what I also wanted to talk to you about is something I picked up on the transfer of shares. And it does state in the IM that basically you can't transfer the shares unless you get board or directors approval. Personally, this is just my opinion. That doesn't sit well with me. I should be able to buy and sell any shares in a company that I've invested in without any restriction on the board or the directors. But ultimately, it says in the IM you're not allowed to do that. I don't know how they'll enforce it, but it says you're not allowed to do that. So it's something you need to be mindful of.